Business valuations. And I have seen a lot of confusion on this over the years, even to the point where some people call it evaluations, and it's not an exam. You're not being evaluated. It is a valuation to determine the value of a business. Now, sounds kind of straightforward, right? You know, if you have a certain number of sales and you have a certain number of bills, well, right there, you just subtract one and you got a valuation. Not so fast. Not that simple. There are actually a bunch of different ways to conduct a business valuation, and depending on the circumstance in which calls for the valuation, there may be different methods of determining that valuation for that particular circumstance. So I'll run through a couple of those circumstances and then a couple of different ways to do the valuation of a business. Now, before I do that, let's be clear. A valuation is conducted by a financial expert. A lot of the times there are valuation firms, there are sometimes CPAs that do taxes that can do valuations, but let's not get it twisted. Lawyers don't typically do these. You shouldn't be doing these, with a small exception that I'll get to. Most of the time you do need to hire some type of professional valuation expert to get this valuation done. I'll start with the one scenario in which I think that sometimes, and maybe even most times, you can get away without a formal valuation. And that is going to be when you're buying out a partner. If you're dissolving a partnership or buying someone out, and this goes for corporations too, when you buy out a shareholder, not just partnerships or LLCs. Anytime you're buying out an owner of a business, there is an opportunity for you and that person that's selling their ownership to just settle on a valuation that you both feel comfortable with. Now, you have to make sure with your CPA and your tax professional that it's not going to cause any issues if you guys decide to just call the valuation $1 when probably it's more than that. But within reason, you can pretty much determine the valuation for that buyout amongst yourselves, which if you're not hiring a valuation firm and you're not doing a whole bunch of really complicated or professional valuation methodology, that's probably going to be a little bit less expensive. And then that saves the company money for the buyout that they're already going to be giving money to that partner that's leaving. So that's probably the only scenario in which I think it's okay for you to settle on your own valuation for the buyout of a partner or another owner. But there are other scenarios in which you definitely need a more professional valuation to be done. So what are those other scenarios? Well, the big one is going to be anytime you're, let's say, buying a business. If you're going to do an acquisition of a business, you need to know what that valuation is, and you need to make that something that's based on some empirical data so that you're feeling comfortable about that valuation instead of just pulling it out of thin air and saying that's the valuation. Again, it also will impact your taxes too, so always important to try to get the lowest valuation, but it needs to still be within good faith and valid. So that's an example of when you would need a business valuation. Another example of a business valuation is going to be when you want to give ownership to your employees. If you want to give a vesting schedule to a new employee, if you want to give them options, if you want to give them equity down the line, any of those scenarios require you to have some basis for the value of that ownership that you're going to give them. And this is the tough one because most small businesses, they want to give ownership to their employees because they don't necessarily have a lot of money to pay them a high salary, but then it requires several $1,000s to get a valuation done to give them that ownership that they couldn't afford to just pay. It sucks. It's a reality. Most laws are not designed for small businesses and small private companies. There are some types of equity grants for employees that don't require a valuation. More on that in some of my other videos. But for the most part, you'll actually need to do what is called a 409A valuation. That's the Internal Revenue Code section 409A. It dictates how that valuation needs to be done, what parameters, and sort of who can actually do those valuations. And sometimes if you have a pretty good financial expert on your team within the company, they can actually do it. They need certain types of experience, which is in that code section, but most of the time, you'll need a professional valuation firm or valuation expert to do that valuation. Why, you might ask? Why can't I just fudge it and give them a certain valuation? Because taxes are always going to be the backstop to these valuations and sort of the check on that validity of the valuation. Why? Because if you give ownership to someone, and then down the line is when they're going to cash in on that ownership, maybe when they get their options or when their vesting schedule's triggered and they want to sell that ownership down the line, if your valuation that you gave it at the outset was dramatically incorrect compared to then what they sell it at or what the value is later on, they actually are the ones that could suffer a tax penalty up to 60% of what they get. So let's say they sell that stock later, they get 100 grand, and then the IRS comes in and says, that valuation way back in the day, it was wrong, you got to pay a penalty. That's $60,000 of that $100,000 score that you just had. So valuations are very important, and it's mostly important for the person that is dealing with the ownership. And so we've covered a couple situations here. Just want to make sure we don't get it lost in the shuffle of all this fun terminology. So buying out an owner, another partner, sometimes you can settle on an informal valuation there if everybody can agree on it. You could still do a formal valuation, especially if there's some contention or disagreement amongst the people buying out the ownership. The other situation is buying a business. You'll definitely need a valuation so you feel fair about that sticker price for that business. I'd recommend a formal valuation there. Or if the parties are friendly, maybe you can settle on one your own there. Anytime you're giving employees ownership or a new owner some ownership and it's going to vest over time or they get that later on, you'll definitely need a formal valuation, typically going to be a 409A valuation. And so these are some of the common scenarios in which you'll need to figure out a business valuation. What types of valuations are there? I said I'd cover a few of those, and I will, but again, not my forte, not usually an attorney's expertise, but let's talk through a few. So there's some pretty informal ways of doing it. Rule of thumb is one of them, where it's just sort of the average of revenue over a period of years, and then that's going to be the business value, and then you can pull from that however many number of shares there are per share value, or if it's an LLC and there's 100% membership interest, each percentage point's worth, however much of that value, of that overall value. Now that's rule of thumb. There's other things that are pretty complicated where you have sort of long formulas that deal with revenue, overhead, any type of liabilities, marketplace conditions. Maybe there's some forecasting for what the future revenue looks like. Maybe you want to factor in a value for goodwill. So you can see where these formulas can get very complex, and that's why sometimes it's best just to go with a valuation firm, because they have this stuff down pat, right? They have it dialed in. They know what they're doing. They know how to assign these values. They've seen hundreds of valuations. They know the parameters for the different value of goodwill and trademarks and inventory, maybe more so than you do. I know as an attorney myself, dealing with buyouts for clients, I've seen certain numbers and I've seen certain things, but they vary wildly. And so a valuation firm is going to know to a little bit more of a certainty what those numbers are. But don't get confused. Valuation firms, if you hire valuation firm A, valuation firm B, they might come up with different valuations. And so sometimes that's why you'll see in buyout agreements that there's going to be 3 valuation firms. And everyone agrees on one of those valuations, or they take the average of all 3, or whatever the case may be. What I'm trying to illustrate with this video, however, is that valuations can be extremely complex. If you're lucky enough to be in a scenario where everything's all good and you can kind of agree on a valuation, great. Make sure that you feel good about it. Otherwise, hire a valuation firm. The few $1,000s will be worth it in the long run to either avoid tax penalties or make sure that everybody feels good about the purchase that they went through with. So, hope this was helpful. Business valuations for all kinds of business situations. See ya.